Good morning, everybody. It's Monday, it's 11 o'clock again. I'm Peter with Choice for Homes Investment Solutions. I'm gonna, in a few minutes here, talk about evaluating buy and hold properties and basically how to price your deals. We're gonna talk about cash flow, we're gonna talk about acquisition cost, we're gonna talk about purchase price. The main point of this presentation is I'm not trying to teach you how to be me, but I am sharing some of the tools and techniques that I use to look at the portfolios, look at the properties to make sure that they actually do produce income and that my investors are happy and actually making money. Now, who am I and what do we do? I'm president of Choice for Homes Investment Solutions. We are a real estate investing company that specializes in creating cash flow through acquiring Class C single-family homes in portfolios and cash flowing them over a long period of time. So let's jump into it. So a couple of things that I want to talk about first. We are gonna talk about investment strategies as they pertain to the business that I do and to the business that I get involved with on behalf and with my investors. For Class A or Class B properties, the math might be different. The individual numbers may vary, but the overall logic is going to be the same. So what we're going to look at today is the difference between an investment that produces as expected versus an investment that we thought was going to produce money, and as a result we're kind of struggling with it. And a lot of the difference comes from the fact that we need to be making sure that we are looking at the investment correctly up front when we're buying it, because a lot of decisions about the quality of the investment and how to treat it have to be made up front when we buy it. And if those decisions are based on incorrect information, then you're going to get in trouble. What I will not talk about today, and that actually I was planning to, so every time before I start this, I play in my head what I'm going to say, and I build the strategy how I'm going to talk about the recurring expenses and discuss vacancies and go into all kinds of details on how to operate a portfolio. And then I started building my PowerPoints, and I realized we don't have time for that. I'm trying to keep this down to half an hour, and we are just going to look at the top level math, and then next Monday, if everything goes okay, we are going to talk about the actual recurring costs of running an investment. I call it portfolio because I'm looking at more than one house. At the end of the day, it's the same investment as a portfolio, as a single family home, as an apartment. The math and the overall principles do not change. So let me jump into the PowerPoint, and I'm going to start talking about through some of the slides I've prepared, and then we're going to look at some math at the end, and then I would love to get a Q&C session. However, as I'm doing this live, I don't have anyone monitoring Facebook for me, so I'll have to switch back and forth a little bit. So let's go and talk about evaluating buy and hold cash flow properties. So let's go to the next slide. I'm going to open up with know your strategy. If your strategy, depending on what your strategy is, your approach is going to change. And this particular presentation is specific to the cash flow strategy. Now, there are three strategies that I like to talk about. It's an appreciation strategy. That is basically where you buy your investment, and it could be a property, could be stocks. It applies to anything. And you expect it to grow in price while you own it. And a couple of things that are specific to this type of strategy, you're going to be looking for something that appreciates in a high appreciating area. You're probably looking at a shorter term investment, kind of in and out within a few years or a few months. And your main area of focus is how much the property is growing, not how much is it cash flowing. Depreciation is kind of an in-between strategy, and that strategy is only available in real estate, and that is basically saying the value of the asset that you own, if it's real estate, can be amortized over a certain number of years, and accountants can help us with how many, but it's I think it's 28.5 or 29.5, I don't remember exactly. And so you get to depreciate a portion of that cost every year and subtract it from your annual income, taxable income. What are some of the requirements for this type of portfolio? Value of improvement on land needs to be relatively high because you don't get to depreciate the land value. So you probably want something, if it's $1 million property, you want it sitting on a $200,000 land, so you can depreciate $800,000 of it. Also, that strategy is probably most appropriate for somebody who is really high net income individual. That individual is not going to care as much about how much cash flow he or she gets per month, rather than how much depreciation they get. So for those purposes, I would recommend finding the highest valued asset that will pay for itself, so you don't have to cut a check every month, and will produce a lot of depreciation. Now, is it possible that that asset will appreciate over time or produce cash flow? Absolutely. But it's not going to be optimal for either one of those. And now finally we get into the cash flow, and that is where we're going to focus most of our conversation today. Cash flow is a relatively low acquisition costs, puts money in your pocket every month. Cash flowing properties are generally recession proof. Now, before you start telling me, oh, what happens if there is a big dip down and the rents get depressed, I'm going to say, if you're looking at an appreciating property in Seattle, downtown Seattle, that you're renting for $3,000 a month, absolutely it's not recession proof. However, if you are purchased an asset that is Class C, kind of out in the boonies someplace, and your tenant is a lower income individual who may or may not be on government subsidy, when the recession hits, those generally don't get affected that much, especially the ones on government subsidy. It is generally noticed, or at least I believe, that when the rents get compressed down, they get compressed from the top down. In other words, your $3,000 a month tenant will no longer be able to pay his rent, and they'll move to something that's $2,500 a month. And $2,500 a month tenant will be looking for something that's $2,000 a month, and so on, until you get to the bottom of the market, where $1,000 a month rent, your tenant is pretty much has nowhere to go. So again, it's an opinion. We can talk about it more, and if you want to leave comments in this particular post about how right or wrong I am, I'm always welcome. Also, ideas are appreciated for future presentations. All right, let's jump into the next slide. Cash flow properties. What are some main of the characteristics of the cash flow properties that I invest in? I recommend for myself and for most of my investors to be looking at those investments at a long-term basis. Long-term investment, 10 years or more. If you are in it for less than that, it's not necessarily a cash flow strategy at that point. The goal here is you're going to buy those properties, you're going to cash flow them for, I want to say forever, and then, when you retire, you would pass it on to your kids as an inheritance. Most of the houses, if properly maintained, will last for 100 years. How do I know that? I've bought some of them who are 100 years old. What other assumptions we're going to make here? We're going to be looking at using debt to finance most of the purchase price. We're going to be using full service, we're going to assume use a full service property management company, and that is going to become more important next week when we talk about ongoing costs. No immediate capital investments required. What do I mean by that? We are not looking at fixers. In other words, whatever we buy, there is already a tenant living in it, and the tenant is living in a decent living conditions. We're not talking about distressed properties. We're not talking about vacant properties. Why are we not talking about it? They're good investment. It's just a different type of conversation. There we would mainly be focusing on the value add aspect of it, and how does the math change when you have to hold that property for 4 months or 3 months while you're getting it market ready, and then putting it into the market at a rent that you don't really know what it should be. We're going to look at fully rented and cash flowing properties, and there are several reasons of that. I will generally not buy vacant properties even if they are allegedly rent ready, because I don't know what rents they're currently bringing. So we have to deal with the concept of projected or market rates, which I don't like doing, because it's uncertainty, therefore it's risk. So I'll buy vacant properties if they're rent ready, but I will expect a higher cap rate on those. And then to make a property cash flowing, your NOI, net operating income, should be more than enough to cover your debt servicing. To cash flow well, it should be more by a significant amount to the investor, where you actually feel that cash coming into your pocket. One of the reasons I don't like doing them one house at a time is because in the type of houses I buy, that difference might only be $100 to $200, which means it's not really that noticeable. But when you buy 10 of those at one pack, now all of a sudden it's $1,000 to $2,000 a month. You have 5 or 6 of those portfolios, and that's a replacement of a fairly decent paying job. Okay, let's move on. What I'm going to focus on this presentation is the overall math on what does it cost to acquire the property, and how does it cash flow, and how does it impact the investor. So I'm going to start out with know your cash flow. The most obvious number that everyone knows is a purchase price. That's the number on the listing or on the offering, or that's the number that people send you. What a lot of the times we don't realize is that when we're buying investment properties, most of them are not going to be on a commercial MLS. Sorry, they are not going to be subject to conventional rules, and so they could be marketed by a wholesaler, they could be marketed by a broker who specializes in commercial stuff, and there could be some expectation there of commission or assignment fees. Now, I'm going to tell right away, if you're going to invest with me, and I find an amazing deal, and I roll it and I bring it to one of my investors, and we JV on that, I'm gonna hit it with an assignment fee. I'm gonna charge something for taking that deal and putting it into the joint venture, instead of just keeping it or wholesaling the deal, because it's an opportunity cost, and I would like to benefit from that. Next one is inspection cost. There are a couple of costs that when you invest in portfolios or apartments or single houses, doesn't matter, will happen whether you buy a property or not. And they will happen at different periods due to due diligence. And what you want to make sure is that you know what they are, and you kind of prepare yourself for the fact that you might have to write a check before you even buy the property. And then if you don't buy the property, that money is lost. So inspection cost is one of them. I strongly recommend inspecting anything you buy with a professional inspector. I also realize that that's non-refundable. Doing an inspection on 10 homes could run, about $5,000. And yes, you are risking those $5,000, but believe me, the risk that you take by not doing the inspection is significantly greater than that. Next would be the financing costs. Now, here's another cost that is paid before the inspection, and that's appraisal. Normally you would do the inspection, and then after that I would recommend doing the appraisal. Why? Because, well, if you're going to drop $5,000 on inspection, and inspection comes in bad, and the seller is not willing to negotiate the price down, then you wouldn't go into appraisal and wouldn't spend that money. Now, if you're okay with inspection, you decided I'm still willing to pay them what they asked for based on the condition of the properties, then you would work with your lender and you basically cut them a check for appraisals. And appraisals can be pricey as well. Then some of the other costs that are associated with obtaining financing for the deal would be the points on the loan and the loan closing costs. All of those can vary quite a bit, but I have an example later on in the presentation where I'll actually talk about those in detail. Be careful if you invest out of state, which for most of my investments I have to go out of state because the cash flows in Washington won't support it. There are state-specific stuff. For example, when we were closing a loan in Florida, turns out Florida doesn't have excise tax that is charged on the transfer of property. What they do is they charge a fee that's actually kind of close in amount, but they charge it on the loan. So whenever you close a mortgage, there is a fee associated with it. That is a bad news for when you're refinancing, because then you have to pay it twice, even though the property is not technically transferring ownership. You wouldn't pay excise tax for something like that in Washington. There you do. And there is also a ticket. There is like a stamp fee, which I think is like $100 per X amount of value. And in a lot of cases, they require, and it would be the title, or in order to record the property, Florida would require land surveys, which could also be pricey. It could be, $300-400 per house to do a basic survey. And so be aware of those costs up front before you make a decision to buy the property. And how to do that: figure out who you're going to use for closing, if this is a local, and it should be somebody local to Florida or somebody nationwide who knows Florida. Call them and ask them what the closing costs are going to be, and they'll tell you. And that's a simple thing, simple phone call. So other closing costs, escrow fees, recording fees, stuff like that. Now, why is that important? Because we are trying to understand the cap rate, to understand what is a cap rate? It's net operating income divided by purchase price, or you could divide it by total acquisition costs, and we'll talk about it in a second. And that will give you a number, a percent number, which is called cap rate, which we will use to evaluate whether the property is a true cash flow property or not. So, going. I've decided not to go into the in-depth discussion of operating costs of a portfolio today. We talked a little bit about it last week, so I gave this rule of thumb to folks, and I said, hey, if you're looking at a portfolio of single-family homes, or a single-family home that rents at around $900, kind of nothing special, one-story, 3-bedroom, 1 to 2 bathroom, your operating expenses should be between 35 and 40% of your gross rents. It might vary slightly from state to state, and again, you go super rural, it will change because your vacancies are going to be higher. But overall, that's where I'm going to use for this particular presentation. I'm going to say 40% is my expense burden, 60% is my net operating income. Those of you who want to know more, wait until next week, or reach out to me individually, and I'll talk about it. Next slide. Now, the value of cash flow property is the function of its cash flow. This is really important to understand. As an investor who focuses on cash flow, you don't care. Well, you don't want to pay above market price for a specific house, but at the same time, you shouldn't care too much that you are paying whether you are on the market or not. And if the seller does, that's unfortunate. I see a lot of the sellers who will go on Zillow, or they'll get an estimate for a house, and they'll say, oh, this is what I want to get for my property. Well, the problem is they own 20 houses, all in the same general neighborhood that they're trying to sell all as one pack. Appraisal, Zestimate, Redfin estimate, your agent CMA are all representations of the market value of the property that is vacant, cleaned up, fairly cleaned up, and on the market with its comps. It could be nice, could be not so nice, but kind of an average. What you're going to be buying, especially when you're buying a portfolio of 20 properties, is you're going to be buying wholesale. You're going to be buying property with tenant that probably hasn't been super well maintained. And if that tenant were to be moved out and you wanted to put the property on the market, you would probably have to spend a few thousands of dollars getting the property market ready. That's why I'm not all that excited about the concept of market price unless I'm thinking refinance, and then that becomes important. But for now, let's focus on this. Let's talk about some terms. Net operating income divided by acquisition cost. That's a cap rate to the investor. That's the number that you're going to care about. Net operating income divided by cap rate, very basic algebra, should be your acquisition cost. Now, your acquisition cost is your acquisition cost minus all of the other acquisition expenses other than the purchase price will give you the purchase price. And I'm actually going to jump into the example later on and explain that. And then the cap rate that you experience as an investor is not going to be equal to the cap rate that the seller sees. And the reason for that is the difference between the acquisition cost and the purchase price. In other words, you're going to pay more for that property than the seller is going to get on his end. And even in a commercial world, that seller is going to focus really heavily on what cap rate he or she is getting, versus you're going to be, or you should be focusing on what effective cap rate you are paying. And there's a gap between that, and a lot of times that gap is really hard to close. And then effective cap rate to the investor, why is that number important? Well, if your effective cap rate is higher than your interest plus principal payments, or the rate, then it's a cash flow property. And if it's not, then it's not a cash flow property. It's not going to cash flow. You're actually going to either not make any money, or you're going to have to write a check every month, in which case you haven't bought a cash flow property. You bought, at best, a depreciation property or an appreciation property. And if you bought it in the market that does not appreciate, and you don't have a huge net income every month, then you bought a liability instead of an investment, and you shouldn't do it. And that's why we're having this conversation. Okay. Example. Before I go there, I wanted to spend a second to talk about the difference between the math that you were going to get and the true math. And I had a totally different example in mind when I was thinking of doing this presentation. However, it was Saturday night that somebody sent me a text and said, hey, I have a 20 house portfolio that's capping at 10.5% in, are you interested? And I was like, sure, send it to me. So here's what I got. On the left is what the wholesaler sent me. And it turns out it's actually a 19 house portfolio. I've changed the addresses just to, to protect the investor and the wholesaler. But it's in fairly rural town, so we'll talk about how rural you want to get in a little bit. But they basically said that current rents, and those are gross rents, I assume, are almost $17,000 a month. They applied expenses, which were tax, insurance, water, sewer, and they came up with a net income. So what's wrong with this picture? Well, for one thing, if you listen to my last week's presentation, some of the expenses you should be accounting for are vacancies, management, maintenance, and capital expenditures, and none of those are in their numbers. So using the really wholesaler math or broker math, they came up with a net operating income of $12,000 a month, or $12,500, which is actually 12,565 divided by 16,920, which is about 75% of the gross income. And as soon as I saw that, I was like, yeah, that's probably not going to fly. And they're asking 1.5 million, which would give you a purchase price cap of 10%. So what I did is I applied some of my basic rules of thumb. So growth, and I'm not at this point. I wouldn't challenge their assumptions on gross rents. Those generally don't tend to be that far off. there might be a few vacant units in there that they're not representing. The house that's renting for $1,800 a month is probably a bogus, but you know, it is what it is. You can't challenge everything right away. So let's assume gross rents are truly 69. Rule of thumb says the expenses are going to be about 40%. Now, on a single family home, I usually will not factor for landlord paying water, sewer, garbage. 40% assumes that the tenant pays water, sewer, garbage. In their case, looks like the landlord does, so we have to subtract that out. That's another $1,000. So we end up with a total monthly net operating income of $9,000 and annual NOI of 109. So 150 that they gave us versus 109 that I think is more realistic. That translates into the asking cap rate as actually being 7.3% rather than 10.1. And I'm going to say, for the sake of this example, we're going to ask, our asking cap rate is going to be 12%. Now, I'm not buying that portfolio. I'm not interested in it because it's too rural. So if I were, I would, because how rural it is, I would offer at a higher cap, much higher cap rate. But for the sake of argument, let's assume 12%. Now, here we get into the rest of the interesting math. So a 12% cap rate purchase price would mean $913,000 would be what we pay to the seller. Let's add in some of the other acquisition costs that I talked about up front. So we're gonna spend about $30,000 in commission and assignments. We're gonna spend 2 points on a loan, and for now I'm assuming only one loan. I'm not assuming anything fancy like that, two-stage financing and things like that. And we're gonna spend $500 a house on appraisals, and that's times 19 houses. And we're gonna spend $500 per house on inspection. Those are, I'm guessing those numbers right now. I can probably get them done cheaper because I have the wholesale relationship with some of the providers. Might cost more for you, but again, to validate, a couple of phone calls should give you a fairly good number of what it's going to cost. Other closing costs, I usually budget at least 1%, and that is for stuff I did not know, I didn't catch, basically a contingency. If it doesn't happen, great, but usually it does. So your total acquisition cost is actually going to be closer to $1 million, $982,000, which would give you an effective cap rate of 11%. So your cap rate usually changes by about a percentage point or 1% due to acquisition expenses. Why is that important? Well, let's keep looking down. So I always like to start my analysis with the end in mind, so from the back. How much money do I want to be making? And then I'll work backwards, or I'll do this analysis and I'll look at the last two numbers. I'm going to say, is this enough? And if this is enough, then the cap rate is high enough. And if it's not enough, then we need to pay less for the property. So we're assuming, since I exist in a portfolio world, and a portfolio world means it's 10 houses plus, and those houses are all going to be financed as one. It's a commercial loan, it's not a mortgage, therefore most of the time you will not find 80% or higher LTV. So I exist in the 75% LTV world, and in that case it would be 75% of the purchase price. So your down payment required would actually be more than 25% of the purchase price. It would be 25% of the purchase price plus all of your acquisition costs, which actually gives you basically $300,000 is what you would need to bring to the table to close this deal. So I hope this is clear right now for now, because next we're going to talk about ongoing expenses. So approximate debt servicing, and again, people who like to be accurate with math are going to yell at me and say, Peter, this is not how it works. You have to compound it. There is a continuous compounding, and the properties don't generally amortize on a straight line basis. I'm going to reply to that as absolutely correct. You're right. However, since we're looking at a 10 plus years for an investment, I'm actually looking at it more on a 30-year basis. On average, your numbers are going to look that way. So Approximate interest expense is going to be about $42,000 a year, and I would expect that you would probably be paying $22,000 in towards principal. Now, are you going to be getting $22,000 to apply towards your principal in the first few years? Absolutely not. As usual, the bank will take 90% of that, and then you will only get more principal towards the end. But for simplicity, I'm just keeping it that way. That will mean that you would per year you would have to pay about $65,000 to the bank. That money that is coming out of your pocket. Now, out of that 65, 42 is an expense, and 22 supposedly goes back into your own pocket. What does that mean? It means that if your net operating income from a prior page was 109, so 109 minus 65 gives you 69. Or was it now? So it was 1095. Yeah, that will give you about 66,000 in. Let me back. Going back for a second. So average annual income would be your net operating income 109 minus your interest expense, just the expense portion of the payment, and that gives you 66,000 a year. Average annual cash flow, how much money you're actually going to get into your pocket, is going to be net operating income minus interest and principal payment, because principal payment, even though it's technically not an expense, you're still not getting that cash. That cash has to be given to the bank. And what effectively this does, it produces an investment, long-term investment with with ROI of 22% and a cash-on-cash return of about 15%, which is actually pretty cool. I think that's a pretty good math, providing that you can buy it at the right price and that you know how your numbers work. Now, what if you said, well, let's say you didn't take into the account all of the acquisition costs, and you said, well, I'm buying at 12%, my interest payment is 6.5%, so 12 minus 6.5 gives me, I should be profiting 5.5%. And then you took the 913 and hit it with, then you would expect to be making about 50,000 a year if you apply it to the whole amount. Is that wrong? No, but you wouldn't be cash flowing nearly as much. And more importantly, as you get higher in numbers, when you're looking at $4-5 million portfolios, the impact is going to be significantly different. And the difference between $3,000 a month paycheck and a $4,000 or $5,000 a month paycheck is something that you don't want to be surprised with. And just for additional perspective, I haven't done it monthly, but your annual income is going to be about $5,500. However, your annual cash flow, monthly cash flow is only going to be about $3,500. So $5,500 a month versus $3,500 a month is a big difference, and if you do not expect that to happen, you will not be pleasantly surprised. If you're investing like I do for your investors, that's not a conversation I want to have with one of my investors and explain to him or her why are they getting $2,000 less on a monthly basis than they were expecting when they made the investment. I hope that's helpful. Okay. Once again, if you have any more questions on this, or you want to sit down one-on-one and go over math, we can do so. Here's my contact information. I'm going to leave it on the screen for a couple of seconds before I switch back. Once again, this is Peter with Choice for Home Investment Solutions. The goal of those videos are not to teach you how to be me. It's to share some of the lessons I've learned, some of them in less than pleasant manner over the years doing this. If you find this information useful, interesting, or you just like looking at me, please share this with your friends. I want to grow my viewer base. All of those videos are also going to be saved on the Choice for Homes Investment Solutions Facebook page, and I'm gonna have a copy of it saved in my YouTube channel, which is also Choice for Home Investment Solutions on the YouTube. Next week, my plan is to go into a more detailed conversation about ongoing expenses. In other words, we're going to be talking about how do we get from gross rents to net operating income. And I will be talking specifically about each individual item. How do you figure out what it is, things to watch out for, things that can go wrong. I mean, just the vacancy rate is going to be a huge discussion. Property management is also going to be fairly impactful. So, in the meantime, like this video if you like it, send more people towards it, like my Facebook page, subscribe to my YouTube channel. I get more excited about doing those presentations when I see more people looking at them. If you want to find out more about investing in real estate or investing in real estate with me, don't hesitate to reach out, Facebook, email, telephone, and we can set up a meeting and chat about it. All right, till next week. Bye.